Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500 and today is Arista Networks, ticker ANET. Over the next 5 minutes, I will discuss both the valuation of this company and my thoughts on its business quality. Let's dive right on in. First up, company is in the communications equipment industry. So it appears that they develop, market, and sell into cloud networking. Cloud's doing really well right now. They have gigabit Ethernet switching and routing platforms. Let's see what else they have. Range of industries, supporting many things, provides post-contract customer support, technical support, hardware repair, parts replacement. Okay, so tells us a little bit about it, but not enough. I'm going to ignore 2011 on this return on invested capital chart because I don't know if that's just the company getting started or a data problem. But what's really attractive here is since 2011 and 2012, this company has had a very high return on invested capital, fairly stable, and always substantially in the double digits. It looks like the lowest year was 2015 and 2018, both at 16%. So that's pretty attractive in terms of return on capital as your invested capital as your low, and highs in the 33%. But basically staying pretty steady above 20% returns on invested capital. Very attractive. I like what I see here. So very positive indicators for a quality business. Return on assets, equity, and return on capital. You see 10-year median returns, all very good. I really like to be above 15%. I see that here for return on equity. I like to be above 10% on the capital, and you see that. So everything I want in a high-quality company is here, looking great. So price to earnings ratio in terms of valuation, this is where we start to see some concerns. The company seems very highly valued at a 42 PE. I like to find companies trading for a PE of around 15, maybe up to 20 if they're a very high quality company, but 42 is extremely high. So what could justify a PE of 42? Well, an earnings per share growth rate of 30% would do it. If you're able to grow at this for the next 10 years, you can start to justify something like a PE of 42. And so the market is clearly pricing in this 10-year CAGR of 35% revenue growth, 58% free cash flow, 32% earnings per share growth to continue over the course of the next decade. I mean, you see what this does here. In 2012, you basically went from $193 million in revenue to $2.9 billion in revenue. You went from 3 cents EPS to 263. So this record is insane in the performance that they've had. They've had massive revenue growth, massive profit growth, very high returns, and that's all led to a very attractive profile for this company. One quick thing. Please hit that like video on this video if you're enjoying it so far. And don't forget to hit that subscribe and ring the bell so you can get notifications as I upload new videos. Now let's go on into the income statement to learn a little bit more about this company. First thing I see here is that the shares outstanding is about the same as it was 10 years ago, but it's not linear. You clearly bought back a lot of shares going into 2014, 2015, and then it's risen up again. Another way to look at this is that you had shares diluted outstanding, also about flat. So pretty flat. We'll have to go look to see what happened here. Maybe there was some share buybacks. Maybe there was something else going on. But you've had SG&A basically 10x over the period of time, which is fine because net income is 40x over that time. But normally would that be of a concern? But really good growth here on the income statement. Balance sheet. PP&E was almost non-existent. So, okay, this is insane. When you look at the PP&E is $144 million, and the net income is $841 million. The returns on invested capital here are absolutely astronomical. Especially because when you think about these assets that are going into that, a lot of that is cash and short-term investments. This company is earning returns on invested capital that are substantially higher that are being reported. Very, very good signs for a quality business. So let's look at cash flow statement. We can see that every year over the last decade, they've had positive cash flow from operations. That's very attractive. You have had some investments here, which maybe that's going into cash. I can't exactly say what that is because it's not PP&E and it's not really the acquisitions. It does see that they issued net issuance of common stock in 2014. So things are a little bit different there. And then you started to have some buybacks in the last period of time. But you've had some stock-based compensation the entire time, and it's only recently starting to be offset, which is why you've had that up and down. Things look really good here. I like what I'm seeing. So I would say this company is a very attractive business on a quality basis, and I think Arista Networks would go on my watch list because these types of returns on capital are rare and are something that you really want to get a handle on. Anything that 15, 20, 30% range can really drive future of business, and it's only as valuable if you have the growth. So the fact that they've been able to drive this growth has been very attractive, and it's probably because they're in these gigabit Ethernet switching ports. Gigabit Ethernet is going to continue to grow in the future. So assuming they have a good position in the business, which is what it looks like to me here, you're well set up for strong returns based upon what I see on this business. So for me, it's a watch list company because the valuation's a little high for my taste, but everything I say suggests a very high quality company. So Arista Networks going on my watch list. Please like this video, hit that subscribe button, and don't forget to ring the bell so you can get updates on future videos. We are working through every company in the S&P 500. Today was Arista Networks. Thank you for listening, and until next time, stop paying fees, start building wealth.